There is a rule in Europe's most powerful economy that was written directly into the Constitution. Not a law, not a regulation, the Constitution. It said the government could not run a structural deficit of more than 0.35% of GDP. For 15 years, Germany honored it with the precision of a surgical instrument. Every other eurozone government watched and felt implicitly judged. The rule had a name, the Schuldenbremse, the debt brake, and for 15 years it worked exactly as designed. Then, in one session, the Bundestag voted to dismantle it. Not because they lost discipline, not because markets forced them to, because the rule itself had become the problem. That is the mechanism, and it is far more complicated than any headline you have read about it. The numbers in this video come from Goldman Sachs research, Allianz GI analysis, and Deutsche Bank data, cross-verified against public record. Every figure is sourced. Every historical claim is documented. By the end of this video, you will understand exactly why Germany's most sacred fiscal commitment became the thing Germany had to protect itself from, and what that means for European sovereign debt, for Eurozone credibility, and for anyone trying to read where this goes next. If this kind of structural analysis is useful to you, subscribe to this channel. This channel covers the mechanics behind the headlines, and this story has a long tail. To understand what Germany just did, you have to understand why the rule existed in the first place. And for that, you have to go back to 1923. Not to the myth, to the mechanism. Because the myth is Germany printed money and destroyed its currency. The mechanism is something more specific and more instructive. January 1923, the French army crossed into the Ruhr Valley, Germany's industrial heartland. Germany had fallen behind on war reparations. Not dramatic defaults, coal deliveries, telegraph poles, timber shipments. Small physical obligations embedded in the Treaty of Versailles. The French and Belgian response was to occupy the industrial zone and take what they said was owed directly. The German government faced an impossible choice: fight back militarily, which they could not do under Versailles, or find a different response. They chose passive resistance. The government called on workers throughout the Ruhr to stop cooperating with the occupying forces. German industry, the whole Ruhr industrial basin, went on strike. Miners stopped mining. Factory workers stopped working. The entire Western industrial core of Germany shut down. And now the government had a second impossible choice. The workers striking in support of national policy needed to be paid. The government had no revenue from the region that had just stopped producing. It had one mechanism remaining, the Reichsbank. What followed is one of the most documented examples of monetary collapse in modern history. Bread that had cost 160 marks in 1922 cost 200 billion marks by November of 1923. One United States dollar, which had bought 4.2 marks before the First World War, bought 4,200 billion marks at the peak of the collapse. These are not approximations. These are documented exchange rates preserved in the historical record. What ended the hyperinflation was not austerity. It was institutional redesign. The Rentenmark was introduced in November of 1923, backed by a mortgage on Germany's land and industrial assets. The Reichsbank's ability to monetize government spending was structurally severed. The mechanism that caused the collapse, the direct line between government deficit and money creation, was broken by design. Germany did not simply become cautious after Weimar. Germany became precise. Every institutional reform that followed traced back to that specific decision sequence. Ruhr occupation, general strike, monetization, collapse. The Bundesbank's founding charter built Reichsbank independence into law. The Maastricht no bailout clause reflected German insistence that sovereign debt could not become a shared European liability. The Schuldenbremse was the final expression of this architecture, a constitutional prohibition against the conditions that had made monetization necessary in the first place. That is not an accident. When Germany writes a fiscal rule into the basic law, it is writing the opposite of 1923 into the permanent structure of the state. The Schuldenbremse was embedded in the German basic law in 2009. The timing is significant. 2009 is the year after Lehman Brothers. Europe was watching governments across the continent take on emergency debt. Banks were being nationalized. Deficits were spiking. Germany's response was to constitutionalize the prohibition against it at precisely the moment everyone else was doing the opposite. The structural deficit limit was 0.35% of GDP for the federal government. German states were required to run fully balanced budgets. Emergency exceptions existed, but they required supermajority approval, carried specific repayment obligations, and came with defined sunset provisions. The rule was designed to be genuinely restrictive. Follow the logic. This is not a self-imposed austerity preference. This is a constitutionalized memory of what unconstrained money creation does to an economy when the fiscal and monetary channels are connected. Germany built a structural firewall and called it fundamental law. For 15 years, it worked in precisely the way it was designed to work. Germany ran the tightest fiscal discipline in the eurozone. Borrowing costs fell to historic lows. Berlin had the institutional credibility to sit at the head of every eurozone crisis negotiation and make demands that other countries could not refuse. When Greece was burning in 2012, when Portugal needed a bailout package, when Ireland restructured its banking system, Germany sat at the table with clean hands. That leverage was real, and it rested in part on the visible, constitutionalized commitment that Germany itself would never require the same treatment. But the rule that produced credibility was simultaneously producing something else, something that took 15 years to become impossible to ignore. Let me slow this down, because this is where most coverage misses the actual mechanism at work. While Germany was running 0.35% deficits year after year, its infrastructure was aging at a rate the country could not sustain. The rail network that had once been the engineering pride of Europe became a national embarrassment. Deutsche Bahn delays ceased to be a news story and became the ambient condition of German transportation. Bridges were closed for safety assessments. Digital infrastructure sat at connectivity speeds that Northern European peers had left behind years earlier. Defense spending fell to levels that Cold War planners would have found difficult to comprehend. Germany's public investment rate, the share of GDP dedicated to renewing and expanding public capital, fell consistently below the eurozone average during the years the Schuldenbremse operated at full restrictive force. The infrastructure investment deficit compounded. Every year of fiscal restraint was another year of deferred maintenance, deferred modernization, and deferred productive capacity. The Schuldenbremse was preventing Germany from borrowing. It was also preventing Germany from maintaining the physical and military infrastructure that its economy and security depended upon. And then came the geopolitical rupture. February 2022, Russia invaded Ukraine. The security architecture that had governed European thinking since the end of the Cold War, the assumption that large-scale military conflict on the European continent was a historical artifact, collapsed in a week. NATO spending commitments that had been treated as aspirational targets became urgent obligations. Germany had a defense budget sized for a continent at peace and a security environment that had reverted to something closer to 1949. The Schuldenbremse was not protecting Germany anymore. It was consuming it. Write that down, because that is the real story of what happened on the 18th of March, 2025. Let me make sure we are all in the same place before we go further. Germany built a constitutional spending limit after Weimar because they understood, better than any other country in Europe, what happens when a government loses control of the connection between spending and money creation. The rule worked exactly as designed for 15 years. Deficits stayed minimal and credibility stayed high. But minimal deficits meant minimal public investment. And by 2024, Germany had a deteriorating rail network, an outdated defense establishment, and an active war on its eastern flank. The question was no longer whether to spend more. The question was whether the Constitution would permit it. On the 18th of March, 2025, the outgoing Bundestag, in its final session before handing power to a newly elected parliament, voted on two simultaneous measures. This required a two-thirds supermajority, a constitutional threshold that exists specifically to prevent ordinary political majorities from rewriting the fundamental law of the state. The first measure created a €500 billion infrastructure fund, structured as a special purpose vehicle sitting outside the regular federal budget, off budget, insulated from the deficit calculation, to be deployed over 10 years across digital infrastructure, rail modernization, energy transition, and industrial transformation. The second measure exempted all defense spending above 1% of GDP from the Schuldenbremse calculation entirely. The result? Germany's planned deficit for 2026, per Allianz GI data, would reach 4.75% of GDP. That is the largest since 1975. That is 13 times the constitutional limit that had governed fiscal policy for 15 years. This is not emergency legislation. This is a constitutional amendment. The distinction is not technical, it is fundamental. Emergency legislation carries justification requirements and expiration mechanisms. Constitutional amendments change the permanent architecture of the state. According to Goldman Sachs' analysis published in February 2026, Germany's defense budget was set at €119 billion for 2026, a 25% increase in a single year. Goldman Sachs projected actual spending would come in closer to 109 billion, as procurement and contracting constraints would limit full execution. Total projected German defense expenditure for the period 2025 through 2030 is estimated to approach 650 billion euros, roughly double the expenditure of the previous 5-year period. If you are tracking these numbers for what they mean to European fixed income markets, share this video with someone who covers sovereign debt. The structural shift in German bond issuance we are describing here is not a short-term event. Now here is where the conventional coverage makes a significant analytical error. Every article about the Schuldenbremse suspension eventually invokes Weimar. The ghost of 1923 appears in the first 3 paragraphs. The fear is hyperinflation. The ECB will be pressured. The euro will be debased. Some of these articles were written by people who should have known the relevant history better. That is the wrong historical precedent. The relevant one is London, 1953. In February of that year, more than 20 creditor nations met in London and agreed to restructure Germany's pre-war and post-war debt obligations. The total relief was substantial. Roughly half of Germany's outstanding obligations were forgiven, rescheduled, or converted into terms that allowed repayment through growth rather than contraction. Interest rates were capped at low levels. Repayment periods were extended across decades. Most significantly, a clause was inserted that tied Germany's repayment obligations to its trade surplus, meaning Germany would only be required to repay at times when it had the external means to do so without damaging the domestic recovery. This is the same Germany that 6 decades later sat across the table from Greece and demanded primary budget surpluses during a depression. The same Germany that made conditionality into the architecture of European rescue policy. The same country that designed the rules that denied Greece the kind of flexibility it had itself received in '53. That is not an accident either. It is precisely the kind of historical irony that tends to accumulate quietly in financial systems. But the mechanism of 1953 is what matters here. The Wirtschaftswunder, the German economic miracle of the 1950s and 60s, was not built on austerity. It was built on restructuring, on the investment signal sent by Marshall Plan participation, and on the breathing room that debt relief created in the immediate post-war years. Germany was given room to grow into, and it grew into that room at a remarkable rate. The external financial architecture of the decade was permissive by design. The intellectual case for what the Bundestag approved on the 18th of March draws directly on this precedent. Borrow at historically low sovereign rates. Invest in productive capacity. Restructure the industrial and defense base. Grow fast enough that the debt ratio falls through expansion rather than through contraction. London 1953, not Vienna 1923. That is the argument on the floor of the Bundestag. And it is historically serious. Let me put the argument plainly before we look at what the data actually shows. Germany is not printing money. The ECB is independent. The Reichsbank route is constitutionally and institutionally unavailable. What Germany is doing is borrowing at its sovereign rate to invest in productive capacity, making the bet that growth effects will justify the debt load over time. The precedent for this strategy working is not Weimar. It is the Wirtschaftswunder. The case exists. Now let us see what 12 months of evidence says about whether it is working. The vote was the 18th of March, 2025. We are now roughly a year into implementation. 2 signals are pointing in opposite directions, anchored to a single policy. The positive signal first. Germany's Manufacturing Purchasing Managers Index reached 50.9 in February 2026. That reading is above 50, which is the expansion threshold. It is the first reading above 50 in 44 months. 44 consecutive months of contraction readings. More than 3 years, during which every monthly PMI data release confirmed that German economic activity was shrinking relative to the prior period. The February 2026 reading does not confirm a recovery. A single data point never does. But it ends a contraction sequence that had become the central story of German economic decline. Consider what 44 months means. That is Germany contracting every single month since mid-2022. The defense sector is the clearest driver of the shift. The German defense industrial base came close to doubling between November 2024 and early 2026, from approximately 243 registered firms to more than 400, per defense sector registry data. A near doubling of the defense industrial base in approximately 14 months. Defense orders, employment in defense-adjacent manufacturing, and procurement contracts are all moving in one direction. Think about what those 2 trends mean together. Defense is expanding, output is still falling. Now the negative signal. Per Deutsche Bank research analysis, Germany faces net bond supply of 234 billion euros in 2026. That is a structural increase in sovereign debt issuance into a market that was calibrated for something considerably smaller. The 10-year bond yield reached 2.79% in March 2026, up from its recent lows, and the highest point in several weeks. The market has not panicked. But yields are moving in the direction you would predict when supply increases significantly, and the fiscal anchor that suppressed them for 15 years has been lifted. That number is worth holding before we go further. And then there is the execution data, which is the most consequential number in this entire picture. IFO Institute research into infrastructure execution gaps found that a substantial portion of the highest priority investment spending was unlikely to reach physical infrastructure in the near term, with estimates suggesting execution running well below the scale of authorized funds. Not because the money is missing from the budget, because Germany's public procurement system, planning law requirements, environmental review processes, and approval architecture were built for a country that does not spend at this scale or pace. That execution gap tells you something about the distance between budget and reality. If this analysis is tracking something you are following professionally or personally, I want to hear from you. Do you think Germany closes the execution gap, or does this become a case study in how democratic systems fail to execute what they formally approve? Drop a comment below with your answer. The responses on videos like this are substantive and worth reading. Goldman Sachs revised its GDP growth forecast for Germany in January 2026 to 1.1% down from the 1.5% forecast issued in March 2025, immediately following the vote. The revision is not catastrophic, but it tells you that the transmission from political commitment to economic output is slower and less linear than the initial market response suggested. So what do we know from the first 12 months? Germany's defense sector is growing at a pace that would have been considered implausible 18 months ago, and the manufacturing PMI has turned positive for the first time in over 3 years. But the infrastructure spending is moving well below authorized levels. The bond market is adjusting to increased supply, and the growth forecast has been revised downward. The political architecture approved what the economy needed. The delivery architecture has not yet proven it can move the money at the speed and scale required. Here is what the conventional coverage gets wrong about the risk profile of what Germany has done. The dominant fear in the public analysis of Germany's fiscal shift is hyperinflation, 1923. The ghost is in every piece. But the European Central Bank is independent under the Maastricht Treaty. It cannot be instructed by any single member government, including Germany. It has a price stability mandate that is legally binding across 20 member states. The specific mechanism that produced Weimar, a government with a direct line to a monetizing central bank, does not exist in the current eurozone architecture. The ECB is not the Reichsbank. I am not a financial advisor, and nothing in this analysis should be read as a recommendation about any specific asset. But here is what the data points to. The real risk is something quieter and considerably harder to quantify. It is the risk of spending down Germany's institutional credibility without generating the productivity gain that would justify the expenditure. Follow the logic to its conclusion. Germany's fiscal credibility, its AAA rating, its role as the Eurozone's floor for sovereign borrowing costs was built on the Schuldenbremse. That credibility was a real and measurable asset. When Berlin issued debt, the market treated it as approaching risk-free. The spread between German and Italian 10-year yields has historically functioned as a proxy for the Eurozone's institutional confidence. German credibility was the base. Everything else was priced relative to it. Now Germany has moved its structural deficit from 0.35% to 4.75% of GDP in a single constitutional vote. The market has not panicked. 2.79% on a 10-year bond is not a crisis, but the direction of travel is established. The anchor has moved not into crisis, but into something that needs to be characterized carefully. It has moved into uncertainty. What happens from here depends entirely on whether the spending translates into measurable productivity. If German rail freight volumes improve over the next 3 years, if digital infrastructure in industrial regions closes the gap with Northern European peers, if the defense buildup creates an exportable industrial cluster, then the debt is self-liquidating through growth. London 1953 is the model, and the model holds. If the execution gap persists, if political constituencies for spending survive beyond the investment justifications that created them, if the constitutional amendment becomes a template for the next coalition to use for its own spending priorities, then Germany follows the fiscal trajectory already walked by France, which has consistently run above 5% deficits, and Italy, which has operated above 4% for years. The The eurozone fiscal compact was built on the assumption that German restraint was structural and permanent. That assumption has now been modified, not eliminated, modified. So what does this mean in plain terms? Not hyperinflation, not a Weimar replay. The slow migration of institutional credibility into uncertainty through spending that does not deliver the promised productivity within the timeframe the bond market is implicitly pricing. Here is the framework the data suggests for watching this over the next 5 years. Germany made the correct diagnosis. The Schuldenbremse had become the threat. 15 years of fiscal precision had consumed the infrastructure it was designed to protect. The vote of the 18th of March, 2025, was a rational institutional response to a structural deficit that had been accumulating for the better part of 2 decades. The treatment is uncertain, and there are 3 indicators that will determine whether this was a London 1953 recalibration or the beginning of a different story. First, does infrastructure spending show up in measurable economic output? The test is not budget disbursement rates. The test is whether German rail freight volumes increase, whether digital connectivity in industrial regions improves, whether the deferred capital stock actually gets renewed. If the execution rate remains far below what was authorized through 2026, the money is moving through the budget but not moving the economy. Second, does the execution gap close or widen after year 2? 2026 is the first full year of implementation. If the gap is structural, embedded in procurement law, environmental review requirements, and planning approval processes, it will not close without legislative reform that Germany has not yet enacted. The gap closing requires action beyond the appropriation. The action has not been taken. Third, does the constitutional amendment remain a one-time recalibration or does it become an institutional template? Every future coalition now knows that the Schuldenbremse can be suspended with a supermajority in a legislative session. The institutional protection that took 15 years to build was adjusted in a single vote. Whether it gets rebuilt is a political question, not a technical one. If tracking this story matters to you, subscribe. The data on these 3 indicators will develop through 2026, and this channel covers it. The answers to all 3 questions are not yet determined, but the trajectory will be readable by the end of 2026. Watch the freight data, watch the execution rate. Watch whether the next coalition treats the amendment as a historical exception or an established precedent. Before the data resolves, this is what Germany is. A country that correctly diagnosed a structural problem, approved the correct scale of response, and now faces the harder test of delivery. Political architecture is easier to assemble than delivery architecture. Germany built both in one session on the 18th of March. Now it has to prove that one of them works at the scale the other approved. The decisions made in Berlin over the next 18 months will determine whether the Schuldenbremse story ends as the London debt agreement or as a cautionary study in the distance between what democratic systems approve and what administrative systems can execute. The outcome is genuinely uncertain. The mechanism for watching it is now clear.